first, we have to start with disclaimers. This is not a solicitation to buy or sell any security ever. And this is not advice. Here is the agenda. We just did the agenda. What is the goal of this webinar? To help you trade better by using advanced statistical concepts and implementing them directly into trading. We will use historical results as a reference. All right, we've gone through the first 2 bullet points. What are we going to cover? We're going to be implementing AI. That's several different types, some of which is from ChatGPT, other large language models, and some of our own machine learning. CML is Capital Market Laboratories. So CML, ML is just Capital Market Laboratories, machine learning. We will talk about return distribution characteristics. And if that just sounds garbled to you, that's fine. There's the webinar is designed for those who have no experience in statistics at all. And at the same time, those who have advanced statistical knowledge, PhDs of the matter, similar, I'm sure you'll enjoy going through some of the basics, and then I'll show you some things that it's possible you've never seen before. I can't say it for sure. We'll also talk about sentiment, and we'll talk about alpha and beta, but in particular, this webinar is about return distribution characteristics. I'm not going to shoot a fire hose at you, right? It's pointed. We'll touch on sentiment and alpha, but it's about return distribution characteristics, okay? So that means specific use cases in return distribution characteristics, in particular, something called kurtosis. You don't have to know what it is. Something called skew. You don't have to know what that is and why it matters. Okay. Then we'll do some stuff in the apps. All right, look at that. We're halfway through the agenda. That was easy, right? All right, first I'm going to give you some definitions. The definitions will start with words, and then they'll come with charts. And, for those of you for whom this is new, I think the charts are just going to be more valuable than the words, but some people learn better with text as well. So I'm trying to offer both sort of the visual and the auditory. Okay. So we're going to be talking about tail risk. Okay. It looks like we're going to be adopting a dog tomorrow. I'm not talking about that kind of tail. I'm talking about the risk of an extreme event occurring that could drastically change the value of a portfolio or investment. Okay. We then talk about something called kurtosis, which is statistically the tailedness of the probability distribution. So tail risk is this extreme event, or the risk of an extreme event. Kurtosis measures how much of that tail risk you have. Okay, kurtosis is a measure of tail risk. It specifically provides information about the tails and the sharpness of the distribution. Okay, again, this is for people who learn better auditory, right? And those who do better visually, I'll follow it up. Don't worry. So if this is still feeling kind of Greekish to you, that's all right. It's okay. I'm speaking to a very large audience, so some people will prefer one, some the other. I'll provide both. It's a measure of risk or opportunity ultimately. So you can wipe out all the top bullet points, and I'm talking about a particular risk or opportunity. Okay, tail events. This is what PIMCO said, right? So one of the largest fixed income shops, right? Bill Gross, Mohammed Al-Aryan. I mean, they both left, but they built it. So tail events are very rare in normal distributions, and normal here, we're not using the word normal colloquially. We're using it fundamentally as a definition, so a type of distribution, a Gaussian distribution. But in finance, they're much more frequent. So we see fatter tails, much fatter tails than people realize. PIMCO said that, and you always want to look at the fixed income guys for conversations and discussions on tail risks, because the only risk they face is tail risk. Right. But there's also the tail of the tails. So tail risk, and then the really edgy stuff in the tails. We're going to talk about that too. Okay, the tail of tails. All right, so let's turn those words into pictures. Okay, so I'm going to give you 2 distributions. One is going to be in blue, dark blue. It's going to be the normal distribution. And the one that's in orange or gold, or however you see that color, is going to be a fat tail. So it would be what we would call larger kurtosis, right? The tailedness. Okay, so the next thing you're going to see is two charts, one on top of the other. Okay, so the blue one is normal. The orange one is fat tails. What do I mean by fat tails? First of all, what are we looking at? The vertical axis, up and down, is the frequency of an event. So the events in this area occur very often, the most often for these two distributions. The events that occur over here or over here, right, they're lower on the vertical axis, they occur less frequently. But in the orange or gold distribution, the tails are bigger. These are the tails, right? So the likelihood or the frequency of a loss is much larger. This is the kurtosis. The frequency of a tail event is much larger. And in particular, in this one, same thing on the right-hand side. The frequency of an event is larger, right? This level is larger than the level down where the blue is. Okay, this is fat tail distribution. Okay, so when I say kurtosis, I'm talking about the fatness of the tails. And when I'm talking about tails, I'm talking about events which happen less frequently. Okay, all right, I'm going to take this image you see, and I'm just going to stuff it in the right-hand corner. Now I'm going to talk about it. These are fatter tails that we looked at, right? I'll go back. These are fatter tails, but they're symmetric. You guys see that? They're symmetric. They're fatter here and fatter here the same amount. Right? So same size tails. This is the downside tail and the upside tail. So we can talk about kurtosis, right? We can talk about tail fatness, tailedness, but we can also talk about the symmetry of it, right? What if we could find stocks where there were asymmetric tails, right? So for example, a bullish speculation, we would want the green, but not the red. We'd want this, right? But we wouldn't want this. We'd want an asymmetry. We'd want the upside to be greater than the downside. Or in a bearish speculation, we would want the red, but not the green. We'd want this, but not this, where the downside is greater than the upside. That would be an asymmetry. So this combines the fatness of tails analysis, kurtosis, with asymmetry. Asymmetry, right? Asymmetric tails. So here's our third definition. Skew. Skew is a measure of asymmetry, or symmetry if you prefer. That's skew. So we have tail risk. It's the risk of an extreme event. We have kurtosis, which is the frequency of that extreme event. And then we have skew, which is the asymmetry, right? In the context of stock performance, the skewness or the skew refers to the measure of the asymmetry of the probability distribution. And as luck would have it, there's two kinds of skew. There's positive skew and there's negative skew. So this part of the presentation was for those who learn better auditory. And now I'm going to go to visual. Okay, I'll go to a few images. So now let's talk about skew in images. I'm going to show you three different pictures. I've kind of gone around the world and shown these pictures, not literally around the world. I've shown people, and these three seem to get the entire population. Okay, so this is one example of negative skew. You notice that like the tail and everything's to the left-hand side. There's no upside tail. It's all to the left, right? Now, or here's positive skew. Right? This is what people would normally refer to. This is what people in standard would call the log normal distribution. This is stock returns, because stocks can only go down to 100%, right? There is no tail risk in a stock. It can go down to zero. But hypothetically, and we're being hypothetical now, a stock can go up infinitely. They don't, but there's a very, very, very long right tail. So stock distributions, return distributions, are log normally distributed. So that's positive skew, that's negative skew. If that picture didn't work for you, maybe a little color. Okay, that's okay. Let's try a different chart. That's one. I'm trying another one. This is what a normal distribution would look like. Normal meaning a Gaussian distribution, not normal in the colloquial sense. And it's a positive skew, kind of leaning over here. And there's a negative skew, kind of leaning over here. Okay, right? So You can think of a normal distribution. You took your finger and you're right at the peak and you just kind of pushed it. If you push it to the left a little bit, you get that positive skew, and you push it to the right a little bit, you get the negative skew. All right. If that picture didn't work for you, I have one more picture for you. It's all three of them together. Blue is a normal distribution, green is a positive skew, and red is a negative skew. So these are my three illustrations of skew. Asymmetry. These are synonyms. Okay. All right, so let's talk about it a little bit. Remember I said in a bullish speculation, we want the green, but not the red. In a bearish speculation, we want the red, but not the green. And then we started saying, well, gosh, what if that means we kind of want an asymmetry maybe? And then so we said, well, actually, asymmetry has a name. There's positive. We would want positive skew and negative skew. So we're starting to get an understanding just at a high level, like what might interest us. I haven't proven that it does interest us. I'm just saying hypothetically it could interest us. Okay, so we refer to this green and red part as kurtosis, and we refer to the asymmetry as skew. Okay, so kurtosis and skew. That's what we're going to be talking about today. This chart and this chart. Our research in the option space is rather famed. And please check my background after this webinar. You know, when someone says our research is famous or we're published in certain places, you know, bullshit. Check. Just check. Okay, so please check my background after this. We'll and in the email where we send out the recording of this, we'll put a link to our background. Okay. But there's some things I want to say. I'm going to share with you the ideas behind what we've discovered, the ethos, the spirit. I'm going to describe to you the spirit, but I'm not going to share the exact algorithm. And you say, well, why not? There's a famous saying, I'm sure some of you have heard it. It's called once bitten, twice shy. So we did some research, some groundbreaking research in 2016. And it was about pre-earnings optimism. It's this idea that right before earnings, a certain group of companies tend to have this optimism that they're going to beat earnings and the stocks just rise. It's not an earnings bet. The trade closes well before earnings, actually a day before earnings. You just ride this kind of optimistic wave. And that research was very, very well read. And some of the largest firms in the world published it on top of us. And most didn't give us credit. Now, unfortunately, I cannot share it to you if it was privately sent to clients. But what I can share with you is what they did in public. And they did some stuff in public. So when I published the research on LinkedIn, some of the people at the firms weren't paying attention that they weren't logged in without their identity, essentially anonymously. And who were those firms? Goldman Sachs, BlackRock, BMO, Merrill Lynch, and Bloomberg. You can go onto my LinkedIn and you can see it. This is I'm not sharing anything that I can't share. I want to share what Goldman Sachs put out before earnings, but I can't. Turns out my lawyer said that'd be breaking a copyright. So, okay, so once bitten, twice shy. So how do you verify the results I'm going to show you if I don't hand you the algorithm? It's a fair question. It's a high IQ question, I would say. It's definitely a scientific question, right? As scientists, we look to disprove things, right? You have to, every scientific method application is to disprove the null hypothesis. Okay. All right. So what I can do for you is you can just do it in Trade Machine. And I'll show you how to do it in a few minutes. Okay. Now, we've made our way all the way through this far. Now we're into results. So what I have done, hopefully for you, is motivated why we're talking about what we're talking about. And now I need to motivate it further because I can talk to you about a lot of interesting things, particularly in mathematics and statistics, which simply don't matter in finance because they've already been discovered. And my claim to you today is that this has not been discovered. But let me prove it to you. So you would do it through Pattern Finder or Trade Machine. Alternatively, you could do it through this webinar. I want to be very clear. I have not demonstrated that any of this matters yet. All I have done is demonstrated why it might matter. So if you're listening to this, and you are, you could be saying, that's true. I'd like fatter tails on the upside for bullish bet, or I'd like skew leaning, positive skew, or both. Hypothetically, it makes sense. It's a logical argument. You haven't proven it to me yet. It's logical. So I want to be clear. I have not demonstrated that it matters yet. That's what I'm going to do now. Just because I spoke about it with some domain expertise does not mean I have provided you value yet. And when I talk about it, I mean return distribution characteristics. Remember at the beginning of the webinar, I said I'm going to talk about return distribution characteristics, and that might sound like Greek to you. Well, now you know what I'm talking about. I'm talking about the fatness of the tails. We can call it kurtosis. And I'm talking about the asymmetry in the return distribution, or skew, if you like. So it, why does it matter? Why do return distribution characteristics matter? Beyond a sort of pedantic conversation of how distributions could work. So the first thing I'm going to do is motivate it with stock returns. Then I'm going to motivate it with win rates on option trades, not returns, win rates on option trades. Win rates. Then I'm going to motivate it with win rates and returns on successful option strategies already in Trade Machine. And I'm going to use statistical significance as our backbone. Let's motivate it with stock returns. This is the beginning of results. If we took the constituents of the S&P 500 in 2018, right? We know what they are 5 years now. So I looked at the constituents of the S&P 500 in 2018. I looked at it on Jan 1st, actually Jan 2nd of 2018. I didn't do anything. I waited till June 30th of 2018. And I said, okay, I want to see the average 1-year return for every stock in that group from June 2018 to June 2023. 1-year return, every single stock in the S&P 500. The win rate, which is simply measured as were the returns positive or negative, was 59.4%. That makes sense. Stocks go up in general, in particular large caps. The average 1-year return was 10%. This is not me doing anything. This is observational. You can do this too. I will show you. You can see how the stocks in the S&P 500 did over the last 5 years. Okay. And I'm not changing the basket. I just said, whoever's in the S&P 500 in 2018, I'll follow you for 5 years. Okay. Then I said, well, what if we took a measure of kurtosis, which I'm not going to tell you exactly how we did it. It's not just the return distribution. And I just said it was greater than 1. This is already standardized for the normal. So for those of you that are statisticians, it's be greater than 4. And the average return went from 10% to 13%. The win rate went from 59% to 63%. There was a 99.9% statistical significance. So what that means, right? What that means in English is that, by the way, we're not done. I have many more to go on this slide. If we just were to stop here, there is a 1 minus 99.9% chance that we would find these results as they are, and that it would be random. So 0.1% chance. Okay. In finance, so generally in statistics, you're looking for 95% confidence unless you're doing some sort of Bernoulli adjustment. And in finance, if you can get anything over 90%, you're kind of like, I think I found the holy grail. Yeah, we're just doing it straight down the middle the normal way. Yeah. Okay. We're not bending the rules. Okay, let's say I said, that's interesting. What if I do you remember when I said the tail of the tails? Remember that? The tail of the tails. What if I said the tail, the upside kurtosis, the net kurtosis, was greater than 3? And again, for those of you that are statisticians, that'd be greater than 6. It's relative to the normal. All of a sudden, the win rates went from 63.1 to 63.9. The average return went from 13% to 15%. Statistical significance rose. Now, I'm only talking about the tails so far, right? I'm not talking about the asymmetry of returns. I haven't talked about skew. Well, let's do that. What if I just said, let's drop everything and just take the skew? Let's say over a 6-month period, I looked at made sure it was positive skew, greater than 1. Okay. You can say 0. Think of 0 as having no return asymmetry. 1 is having, anything greater than 0 would be having a return asymmetry. That's what we call positive skew. And this is kind of a fairly large positive skew. Okay, now the win rates go to 64%. The average one-year return goes up to 16%. Right? We call this asymmetry. Okay, I'm not going to go through everything, but here's the last one. What if I said, well, what if I took the tail of the tails? I took the one-year kurtosis, was greater than 3. I took the medium-term skew, 6-month greater than 1, and the one-year skew greater than 2. So I took the tails of the tails, and I took asymmetry. Here's what we got. The win rate went from 59% to 66%, and the average trade went from 10% to 20% with very strong statistical significance. So look, as we kept adding return distribution characteristics, how the win rates went up and the returns went up. Right? This is the net. So remember this. Remember when I said I have not demonstrated that it matters. All I have done is demonstrated why it might matter. Now for stocks, I have demonstrated that it matters. But let's be clear. I said I want to motivate with stock returns. Let's start there. The trading strategy was a triviality. There was nothing special I did here. I checked the skew and kurtosis for each stock in the S&P 500. And if it qualified, I held the stock for a year and I did nothing else. I used no technical analysis. I didn't check if I should hold it for 6 months or 3 months or 9 months or 17 weeks. I didn't rebalance the S&P 500. That was a triviality. That's the entire strategy. It's not clever. It's the results that are not a triviality. So I want you to imagine your win rates rising by about 10%. By about 10%, I mean going from 59% to 66% is about a 10% increase in win rates. With 99.9% statistical significance. And now I want you to imagine your day trading, your swing trading, really swing trading, I shouldn't have said day trading, your swing trading returns doubling. Just because I checked an annual holding period doesn't mean that we're going to do annual trades. Right? So that's the takeaway for stocks. The strategy can be optimized. It was rather trivial. The results were not a triviality. This is a remarkable finding for stock traders. The ability to double your average returns and see win rates go up about 10%, not 10 percentage points, 10% comparatively, is life-changing, if it's sustainable. So it's a remarkable finding for stock traders, and it should translate into truly remarkable finding for option traders because options are levered. So I said, first, we would motivate it with stock returns. We've done that. I said, second, we would motivate it with win rates on option trades, not returns, first win rates. So I tried something really boring. I took a put spread and I just did it every month for every company in the S&P 500, same group. That's all I did. Every month. I didn't care if there's earnings, there weren't earnings, technicals, blah, didn't care, blindly. Every 30 days, roll, sell a put spread, sell a put spread, sell a put spread. The win rate was 61%. You know you can have a good win rate when you're selling put spreads, right? Yeah, but it's still a shitty strategy. Right? I can give you win rates that are 80%, which have bad returns. I can make you feel really good about your win rates. So next thing I did, I said, hey, what if we just took the one-year kurtosis and said it was greater than 1? Our win rates went from 61% to 64%, but this is over almost 16,000 trades. There's no such thing as 100% statistical significance. Excel doesn't have enough decimals to show the 99.9. But again, a shitty option strategy is still a shitty option strategy. Okay. Don't worry, there's a point to this. If we look over 3 years, again, win rates that's fine, but you're not making any money, okay? We add kurtosis, our win rates are statistically significant to, 10 decimal places. Returns are a little better, but this is just a bad option. A dumb option trade is still a dumb option trade. Just selling a monthly put spread in the S&P 500, every constituent of the S&P 500 is not a good strategy. If it was, we wouldn't need this webinar. We'd all be rich. And then over half a year, same thing. Win rates are actually much higher over the last half year, which shows you that in the last half year has been a bull market. In a bull market, this appears that it might work even better. But again, bad strategy is a bad strategy. So I'm going to move this chart up a little bit. Yeah. So I told you that that there would be a statistically significant impact on win rates. I'm intentionally looking at a non-strategy, right? Something that should not win, should not have a positive average return. These average returns likely reflect commissions. We have commissions in Trade Machine. I think commissions are around 2%. So basically, you're just giving your money to the market. But a bad option strategy is still a bad option strategy. Right? I said first I would motivate it with stock returns, it being return distribution characteristics. I did that. Then I said I would motivate it with win rates on option trades, it being return distribution characteristics. Then I said I would motivate it with win rates and returns on successful strategies that already exist in Trade Machine. Now, let me prove it to you. We just did the benchmark, selling a put spread. These are the same numbers that I just showed you. Now, I'm going to show you a strategy that's in Trade Machine, fade the dip. It's also selling a put spread, but only when certain technical conditions are met. Okay? The win rates go from 60% to 75%. The average returns go from a loser to a winner, and the statistical significance is through 32 decimals, through floating point precision. Okay. Now I'm going to take the fade the dip and say I only want to do it in companies where the skew is positive, and which means it's a right-leaning skew, and the same kurtosis, the one-year kurtosis is greater than 1. And here are the results. There's no statistical difference between these two win rates, but now we're looking at a benchmark that went from -5%. Trade Machine provided extraordinary value, getting the same trade, but going 8% positive return. Now we're at 14%. Let's go further. Over 3 years, this is actually not the NASDAQ 100. I don't know why it says that. This is the S&P 500. Sorry. You've seen these numbers. This is the same numbers from prior slides. Now fade the dip. Look at the win rate. Statistically significant from a -3%, from a 3% loser to an 11% winner. Fade the dip with tail dynamics. 17% returns. How about the last half a year? The last half year, the returns went from -3 to 4, but that doesn't really count anymore because we're getting very few trades, 35 trades. So let's look at the entire S&P 500 for fade the dip. Over the last half a year, go from -3% to a +9%. And the win rate is statistically significantly larger, both to the benchmark and to the prior fade the dip. So what happened? Fade the dip is a winner. This is the immense value of Trade Machine as it exists currently. Current Trade Machine members, you've been getting a lot of value with this strategy. But fade the dip with skew and kurtosis is a bigger winner. And this is the start of the immense value of Trade Machine's upgrade. Just the start. We've just begun. Let's look at something else. Selling a put spread is selling options. It's receiving a credit. Let's go the other way. Let's buy a call spread. Remember, I told you that what we discovered was this pre-earnings optimism, and it was copied by many large banks, Goldman Sachs, down the line. I wish I could show they actually publish it to their clients. If you're a client, you know. If you're wondering, wow, that was weird in 2018, they started talking about bullish bets into earnings. Yeah, that's weird. So in Trade Machine, we have a 14-day calendar spread. This is over the S&P 500, 5 years, win rate's 55%, average return is 6% in a week. This is a 1-week trade. Okay, let's add kurtosis to it. The win rate goes up to 56%. The average return goes up to 10%. Statistical significance is almost at 95%. Let's go to the last 3 years. Trade Machine's giving you 10% a week. We add kurtosis, we're at 20% a week. And the statistical significance on the win rates is now 97.5%. Let's go to the last half year. By the way, that's obviously a doubling of the average return. Now, let's go to the last 6 months. As many Trade Machine members will know, if we've been using the current strategies, it feels like we've been running in the mud a little bit. With Kurtosis, 4% went to 11%. And that, of course, is nearly a tripling of the average return. We've shown a doubling of the average return in stocks, and now a doubling or a tripling of the average return in options, with statistical significance across a variety of strategies. Selling options, buying options, ignoring earnings, before earnings. The pre-earnings calendar is a winner. And that's the immense value of Trade Machine as it exists currently. The last 3 years have been good. A pre-earnings calendars with Skew and Kurtosis is a bigger winner. And this is the start of the immense value of Trade Machine's upgrade. Let's do it again. We have something called buy the dip in Trade Machine. We use Bollinger Bands. I won't give away the exact technicals because Trade Machine members pay too much money for me to do that. Over the last 5 years, it's been really, really good. 59% win rate on buying options. It's a spread, but that's very, very good. 13% on, I think this is a 2-week trade. Great. Now we add Kurtosis. Kind of the same. Kind of the same. Many fewer trades, kind of the same. What if I added the tail of the tails, though? The average return went from 13% to 23%. Let's go further. Over 3 years, not working as well, which means it worked 5 and 4 years ago, but for the last 3 years, it hasn't been working that well. Well, we add Kurtosis in there, a particular type of Kurtosis. The average trade goes up to 11%. We add the tail of tails, the win rate jumps higher, and we go to 13%. That's from a loss to a gain. This is over 2 weeks. Let's do it over the last half year. Again, something very odd is happening in the bull market. Some of the old strategies aren't working. You add Kurtosis, the average trade is 53%, and the tail of tails, it's also 53%. Granted, this is only 12 trades, so let's not get too excited. The point is losses are turning into gains. So buy the dip, Bollinger has struggled, but buy the dip with Kurtosis is a huge winner. Remember I said first I would motivate it with stock returns, it being return distribution characteristics. And then I said I would motivate it with win rates on option trades. And then I said I would motivate it with win rates and returns on successful strategies already in Trade Machine. I did that too. I showed stock. I showed 3 option strategies. I could have filled 5 hours with the strategies that exist in Trade Machine and how they've improved. This is the second time in my 25-year career that I've seen what can be called the statistical anomaly, or even an aberration. An aberration is a departure from what is normal, usual, or expected. This is remarkable. As of July 3rd, 2023, Pattern Finder and Trade Machine will exist with and without Skew and Kurtosis. So it will exist as it exists today, and then it will exist with Skew and Kurtosis and other AI. Remember I told you there's going to be sentiment alpha. I'll show you that too. I just didn't want to give you a fire hose. With and without Skew and Kurtosis, the price will not change. If you are unmoved by this aberration, that's okay. You don't have to be. You can buy Trade Machine or Pattern Finder if you so wish for the price it is today. With Skew and Kurtosis, the price of Pattern Finder will triple and Trade Machine will double. That's if you join after July 3rd. If you join before July 3rd, you get it for the current price with the free upgrade. I just want to remind people of what we found, and then we'll go a little bit further again. Remember the stock trading strategy? That was a triviality. It could certainly be improved. The results were not a triviality. I'm going to gray that out for a second. I want to talk about the options. The option strategies were not a triviality. right? Fade the dip was remarkably better than the benchmark of just selling an option, a put spread. So Trading Machine tested strategies already. The results were also not a triviality. I want you to imagine now on your option trades, your win rate's rising by about 10% with 99% statistical significance, and imagine your average returns doubling or tripling. That's the option takeaway. These are the takeaways. A doubling or a tripling over the long arc of trades. Am I guaranteeing that? No. Who guarantees anything? That's ridiculous. Can you prove it to yourself that that's what's happened? Yeah, you really can. Trade by trade, day by day, price by price, stock by stock, strategy by strategy. Absolutely, you can. Every single decimal point. You can test it yourself. Prove it to yourself. Will you be able to replicate these new measures? No, you will not. Once bitten, twice shy. These results are discussing the long arc of a career. So I'm going to show you some more, and I hope someone will remember, someone will remind me. I have a message for traders, has nothing to do with Trade Machine or Pattern Finder or CML Pro, nothing to do with Skew or Kurtosis, not selling anything, something that I need you to hear, because we are each the protagonists of our own lives, right? We're each the main characters in our own lives, right? Embrace that and love that while you love others, of course. And so in my movie, where I'm the main character, I'll have one object of desire, right? That's how movies, just so you guys know, that's how movies are made. We have a protagonist who takes a path to get to their object of desire, and it's through that their expectations and their expected outcomes, and then how life is different than their expectations, that it creates story creates a movie, blah, blah, blah. Okay. So you always have a protagonist and an object of desire. My object of desire in my movie is to help people. And it's not just in finance. I spend a lot of time and a lot of money on medical research. Okay. So since I'm the protagonist of my movie, I want to tell you something important, but it's not right now. It's going to be at the end of the webinar. Hopefully someone will remind me, because anyone who's been on these webinars knows very well, I don't remember anything that's not written down. Nothing. So the reason I'm not saying it now is because I use a little bit of foul language, and I know it is just an absolute honor that I know some people bring their young ones to watch some of these webinars, and I'm not going to betray that trust. So when the language becomes rated R, I'm going to put a big disclaimer. I'm going to tell people, I'm going to put a timer on the screen so kids can mute for 30 seconds, and then we'll bring them back. Okay. So that now is not the time. So next part of the webinar, we'll look how fast we're moving, is in the platform Pattern Finder. Here we go. By the way, you know how I said in Pattern Finder and Trade Machine it would be in July 3rd? I was just kidding. It's in Pattern Finder right now. Let's go to stock screens. Let's go to our directional charts. Let's go to bullish charts over 3 years. I'm going to choose ticker TDC. And why is that? Because its 1 year kurtosis is very large. Its 6-month kurtosis is very large. Its 1 year skew, that's its asymmetry, is large, and its 6 months asymmetry is large. Okay. Notice automatically these 4 numbers are in every single screen pre-built in Pattern Finder. You don't have to do it. We did it for you. Let's click on the chart. Okay, here's the chart, the 3-year chart, which in and of itself is like, I guess, I don't know, like uptrend, I don't know, of course. So first, let's turn on some congestion lines. Okay. We can see that it just crossed through a congestion line that was formed through some peaks and some troughs. While we're at it, let's turn on trend support and resistance. So here's trend resistance right at the all-time high. Here's trend support on higher lows. Let's make sure we see all the patterns. We see now that this congestion that just broke through was through the top of a cup, the bottom of a cup with handle, and 2 other tops. And while we're at it, let's take a look at our profit and loss zones. This is a stock which has a bullish chart. It is a bullish chart because its next downside P&L zone is about 3%, right? You'd stop out at around, I don't know, 51. Small stop. Next upside is near that all-time high, which would be, I don't know, like, what's that? 59, right? That's an 11.7% upside. And one other thing now, remember what I said, it's the long arc of a career. Now we have in our back pocket, if we go to financial stats, we scroll down, we know the kurtosis, both measures, both time periods, and the return asymmetry, skew, if you prefer, is positive. Now we have probabilities in our back pocket, statistically significant probabilities over 5 years, 3 years, and half a year. Now we can measure a trade not just by the strength of its chart, but by the strength of its return distribution characteristics. Let's build a new screen together before we go to Trade Machine. And then before I go to Trade Machine, I'm going to show you something else you guys now have. Stock screen. Let's create a new screen. I want revenue in the last year to be at least $250 million. I want free cash flow. I'm just going to search for it because I can't find it everywhere. Free cash flow margin to be greater than 0. I just want companies that are kind of making money. Fine. I want the market cap. I don't like trading micro caps. You can feel free to. Market cap, I want at least, I don't know, $500 million market cap or whatever. Okay, now I want to do the kurtosis stuff. You know, that stuff Ophir talked about. Kurtosis. Oh yeah, with the 1 year kurtosis, let's do a tail of tails. Greater than 3. Remember that tail of tails? Bug. Bad. Okay, 6 month kurtosis, greater than 1. And since we're here, let's do the skew. I don't know, 1 and 1. I don't know, just making up numbers. Okay, this isn't quite working. So obviously, we're going to have to refresh. Actually, I'm going to refresh. Let's take a look. I actually don't care that much. Let's see. Sort by market cap. Let's take a look at, I don't know, Cisco. So these are companies which have a certain amount of revenue, they have positive free cash flow, they're not micro caps, and they have all of the tail dynamic, return distribution dynamics that we've talked about. So I'll just choose Cisco, for example, click on it. I'll just close this for a second. And here we go again. Here's a stock. I'll take off the highs and lows so we can look at this a little more clearly. It's going to fight through this double bottom. It's the end of an ascending base. It's right here. Its downside is to trend support, which is about 7% downside. There's about 9% upside to what would be about $56, which would be the intermediate point of this double bottom. And we have kurtosis and skew on our side. And we know that. We saw it in the screener, but we can always just check. Right, here they are. So that's just an example. And if you want to go through those quickly, we can just view this as a watch list. Here are all the tickers, and we can just, I think I can hit space bar maybe. So we can go through each chart. If you want to, don't worry, I'm not going to do it. But you can go through each chart, wait until you find one you want, knowing full well that what you have now is return distribution characteristics on your side. Looks like ALGN is up after hours, by the way. Right? So that's how you would do it. Okay, now the piece de resistance. Click on Ask GPT. You're allowed to now. Let's say I wanted to see tail dynamics and skew dynamics. I would compare a stock to the market. We looked at, let me X out. There's a little X here, you can't see it. It's because I'm an admin. Sorry, it's going to take me 4 hours to get it. When we went to our bullish charts, TDC, right? So let's say we wanted to examine TDC further. Let's go to Ask GPT. This is now giving access to both ChatGPT, but also our own AI, right? It's kind of a handshake decision tree. So compare TDC to the market. Ask. Do a little learning. Hypothetically, this will work. So I'll show you, or we will show you the summary for TDC since 2020, January 2nd, so about 3.5 years. I'm going to go a little further. Here's over the last year. Start date and end date are right here. So officially it's 0.99 years, not 1 year. These are the number of days TDC outperformed and the number of days it underperformed. On the days it outperformed, it was 0.9%. And the days it underperformed, it was 0.83%. So it outperforms more often than it underperforms, barely. On the days it outperforms, it returns more than it does when it underperforms. So that should mean it outperforms, and it does. TDC returned about 40% in the last year, while the market's done 15%. But here's our dynamics. The upside kurtosis, our proprietary upside kurtosis, is 36. Remember, I talked about the asymmetry. So there's a kurtosis on the right-hand side, the tail, the fatness of the tail is 36. The fatness of the tail on the left-hand side is 17. Remember, I said in that slide, I said, what if we could have asymmetry in those tails? So the net of this minus this, means we have this positive kurtosis the way we're computing it. It's a rather involved computation, and it can't be reverse engineered, which is great. Right? So this minus this is what you're going to find in the screener, about 19. Same thing with the skewness. This is the right-hand side and the left-hand side. You want this plus this to be positive if you're looking for a bullish strategy, or if you're looking for a bearish strategy, you want this plus this to be negative. And we know that about TDC because that was in our screen, right? Here is a chart of the days it outperformed and the days it underperformed the market over 1 year and 3 years. If you wanted to compare a stock to another stock and not just the market, like if you wanted to compare Apple to Microsoft, you can do that now too. Okay. Apple has outperformed Microsoft 21 more days than it has underperformed in the last 3.5 years. Let's see the last year. 6 days, six more days in the last year. Its outperformance day is actually smaller than its underperformance day, which is another way of saying Microsoft's outperformance day versus Apple, right, is larger. And then you can see the proprietary kurtosis and skew dynamics re-centered around Microsoft and Apple. Right? So this is now a resetting. So if you were a pair trader, I know of nothing more powerful than this. I've never seen anything this powerful in pair trading. And this is if I'm a former hedge fund manager, which did pair trading. I wish I had this. And then you can see how the two compare. And while we're here, remember I told you there were other things I would show you? Okay. You can also find stock alpha. So what's NVIDIA's alpha? And while we're at it, it's beta. So does NVIDIA have alpha? Is it statistically significant? It has been over the last 3 years. You can do this for any company. And while we're at it, what is the sentiment for Apple? Any company, by the way, you just put in a ticker. If you want to know how to write a prompt that will be ideal for our AI, click a button, it'll write it for you. Apple has a lot of sentiment information. I probably picked a bad ticker, sorry. Okay, so we have a bug. So we have a bug here. We'll fix it. All right, so that is the AI. Oh, and to get out of this, there's a little X here again. You can go right back to Trade Machine. Okay, so that is the AI that's not available to you, that is now available to you. If you're just a pattern finder member, this is live. We got a little trouble with this, the way the screens were working. We have to fix that bug, but it's in here. And any screen that is built into, you can build any screen you want, of course, but any screen that's already built into Pattern Finder should already have the return distribution dynamics already in there. So you can order by it. Okay? There you go. So you're welcome. It's live. Knock yourselves out. I promised you I would deliver it, and we did. If you want Pattern Finder for the low price of $28 a month before the price goes up to $84 a month, I'll show you how to do that later. But I have to deal with Trade Machine members. So I'm going to go to my development box, and therefore I'm going to hide my URL. And that's how you do it. So let's talk about that 14-day. This is Trade Machine, by the way, for anyone who's new. So this is what it looks like. You go to the Today tab. This is on a development box. So, okay. I was talking to you guys, if you remember, about a few strategies, but in particular, I talked about the 14-day pre-earnings calendar. So I want to look at the NASDAQ 100. I want to go here. It's the 14-day diagonal I talked about. Let's do it for Apple. All right, so I'm going to show you the results. Actually, since I'm here, let's do it for Apple and Amazon. Might as well look at a couple figures, and we'll do it over 5 years. So this is the standard trade machine 14-day pre-earnings diagonal trade that you guys all know. Okay, so I'm going to save this. I'm going to cut it. So I want you guys to see this. This is what this is. I've just taken those results. So when I bring it back, you'll know what it is. Yes. Okay. All right. Now what I'm going to do soon, days. So if you recall, all I did was I said the 1-year kurtosis was greater than 1. I'm going to do the exact same backtest, nothing else. I'm going to show you, remember the results I had before? Okay. So this is the old one. This is old. So the return for Apple was 42%. Now the return for Apple is 114%. Same trade. All I did is I avoided the times when the skew and when the kurtosis was not in my favor. Amazon was actually negative over the last 5 years. It was 12 trades. It only triggered 2 times in 5 years, but now the return is 32% as opposed to, obviously I did this over thousands of back tests, but I'm just showing you an example of how you would do it in Trade Machine. You can take any strategy, either one that you build yourself or one that you get from the scanner, something that someone else shares because all these are shareable. I went into the technical open and I added the 1-year skew. If you want, you could add the 6-month skew. Kurtosis. You could add the 1 and 6-year skew. So return asymmetry is fancy name for skew, and kurtosis is a fancy word for tailedness, right? So that's how it works. That is the end of my formal presentation.